Hey guys, we are live with Dimitri today, and this is my buddy. Great guy to bring on here, especially with the times we're living in today. All types of stuff going on geopolitically. Always love to bring Dimitri on to talk about this. He is the senior research analyst over at PitchBook. He's going to be talking to us a lot about a lot of things today, but sovereign AI is going to be one of our main topics today, and how it pertains to the commodity cycle. We keep talking about the fact that all this energy usage, whether it's AI, what's going on globally, the grid, and so on, is going to mean more a boost to commodity prices. So he's the perfect guy to bring on here today. So Dimitri, first off, how you doing today? Good to see you, brother. It's been a minute since we got to do a live video together, so I'm excited to do this.
Jason, it's good to be here. Yeah, it's been a while. I've been good. I'm really excited to talk to you about sovereign AI today because earlier this week I published a really unique piece because it is the first of its kind. You wouldn't be able to get this at any institutional bank. No other data service provider that at least has been able to connect all of this data and the stories. You've seen research about sovereign AI. You've seen, let's say, The Economist do an article saying NVIDIA is at the center of it, and you may see, some one country in-depth analysis, let's say, of their sovereign AI initiatives, whether it's Saudi Arabia, the UAE, South Korea, Germany, etc. But throughout all of my time researching this topic, I never found one comprehensive source that connected geopolitical trends, policy, and private market slash public market activity. This report ties all of that together to show essentially to answer one question, which is how are sovereign AI initiatives impacting public and private markets? That is the central premise of this paper that I answer not just with data, but also through speaking with people and not countries, pardon me, companies that are at the center of it, essentially, and at the frontier of these AI technologies.
No, I'm so excited to do this because you were talking about it. You were sounded so excited to talk about this report, and I know you were kind of keeping it hush hush for a little while. So I'm really glad to kind of see it come out, and now we can kind of talk about it publicly and bring it to our viewers today at the Gold Rush. So I'm excited to do this. So what's this first chart you have up here? Let's bring them up. Let's start going through
Yeah,
them.
yeah, definitely. So before I get into that first chart, I kind of want to explain the framework of the paper really briefly.
Let's do it.
So essentially the paper looks at three policy vectors that I identified across the world, which are bureaucratic allocation, legislative slash industrial policy, and sovereign wealth funds. Each of those three capital slash policy vectors are unique to each region and country. So, for instance, you would have industrial policy slash legislation fall under, let's say, the West. So that's the United States and Europe, the Chips and Science Act, the European Chips Act, et cetera, right? So that's a legislative policy that's saying we're going to give tax incentives, grants, credits, et cetera, in order to further bolster or rather fortify their domestic AI and chip capabilities. You then have bureaucratic allocation. That's kind of more specific to China. China has obviously a massive state apparatus that is injecting huge amounts of capital into what are called strategic emerging technologies, which is part of their policy shift in industrial policy from 2016. It's really started before '08. The short version of that is that rather than doing horizontal, which is broad sector agnostic infrastructure, this is specifically targeted infrastructure with strategic technologies, quantum, AI, de-risking supply chains, semiconductors, software, et cetera. And you actually see that incidentally in another report I authored recently that, surprise, surprise, and it was actually a surprise, Chinese AI companies have actually outperformed their U.S. counterparts when it comes to stock performance, not only year to date, but on a quarterly basis. And of course, if you dig deeper, it's massive state injected capital. So again, another example of bureaucratic allocation, but I don't want to dive too much into that. Then you have your sovereign wealth funds. That's your UAE, your Oman, Qatar, Norway, with a little asterisk there. And I can explain a little bit more about that. But essentially, the paper says, okay, here are the three policy vectors. Here are a number of regions where that policy vector is reflective of that country's unique political economy and how capital is distributed. And the chart that you're looking at here is AI and ML VC deal value with government or sovereign wealth fund participation by region. So in short, what that's saying is that this is looking at how many how much deal value was created involved that has to do specifically with AI, and what portion of that has involved a government or sovereign wealth fund. And you can see it's quite high. It's in the multi-billions, and it's skyrocketed in 2025. And you'll notice there that the United States takes up the overwhelming majority of that, meaning, and this is part of a broader trend, but essentially the US is a technological juggernaut where it's GPUs now and its advanced technology that it sets the standard for and is the leader because they're the one imposing export controls. It's kind of like, this is a bit tongue in cheek, but it's almost like a reserve technology, right? You have your reserve currency. This is almost like a reserve technology that's a strategic asset that they can leverage in international affairs. And it kind of functions almost as a safe haven. And I put that in really big quotes, but it's the same dynamic that the US has asymmetric control in this respect. And you can see that reflected particularly in the next chart. If we can go down below.
And Dimitri, just on this one chart, like looking pre-COVID, you can see that Asia was much bigger than North America. So is this kind of, I don't know if you want to call it a moat that the United States has now? Has that just happened post-COVID?
I think post-COVID, because really with the creation of ChatGPT, I think that really accelerated it. So that was on the software front. And then that's obviously when GPUs, specifically NVIDIA's GPUs, ended up having immense value because they were no longer just being used in video games, but they were used in training these LLMs that have applications, not just at the horizontal level, but can be used in finance, in healthcare, in diagnostics within healthcare, retail, commerce, IT. I mean, it just ranges. So it's not a coincidence that as the US had this technological moat in software and hardware that suddenly saw this massive influx of capital go into the United States.
Gotcha. That's really fascinating.
Yeah,
This
and
next
that's what,
chart.
yeah, so that's really reflected here. So I can tell you a little bit about this because some context is provided. So within AI, I have four segments, which are semiconductors, autonomous machines, horizontal platforms, and vertical applications. So we're only going to focus on two of these. Horizontal platforms, that's basically like, to think of it simply, your ChatGPT, your Grok from xAI, your Claude from Anthropic, right? It is the horizontal enabler that you build at the vertical application layer on top of it. So the vertical applications, that's like Harvey in legal, for instance, right? It's an LLM wrapper, which is a way of saying that rather than build their own LLM, which is incredibly costly, it costs hundreds of millions of dollars, they can just build on top of it. A metaphor that I like to use for that is social media. Everybody doesn't have their own social media page, or rather they don't have like Dimitri.Zabelin.com or Jason, or Sam.com. Instead, you go onto a social media platform and you build on top of that, and you build your profile rather than building out your own social media platform, which is costly and it doesn't make sense. You can kind of think of the horizontal platforms and the vertical applications like that. Now, what this is a trailing 12-month VC deal activity by segment. The blue columns are deal value, and the little black dots are the count. You'll notice that over a trailing 12-month period, horizontal platforms attracted way more capital than vertical applications. But you'll notice that the overall number of deals are smaller. It's actually less than half. So we have 1,507 deals. And then we have 3,570 for vertical applications. That difference in large part has to do with the cost differential, because these horizontal platforms, they're massive checks, hundreds of millions of dollars. I think NVIDIA had the biggest funding round, if not the biggest funding round in history, is like a $40 billion funding round. Not many VCs can write those kinds of checks. So you're going to have very few of them, but the overall deal value is going to be significantly larger. Vertical applications, it can be as little as $3 to $10 million. So naturally, you can have a lot more deals, but the overall deal value is significantly smaller. So if you take those two charts that I just put, the one above and this one, what you see is an immense amount of capital going into these horizontal platforms, because we don't know who's going to win at the vertical application layer. Nobody has a moat yet. Nobody has a key differentiator, but they're pretty sure it's going to be built on top of, they're pretty sure it's going to be built on top of these horizontal platforms. And that's where a lot of the money is going in. I've spoken with VCs, I've spoken with CVCs, and the bets are generally the same, which is we don't know who's going to win at the vertical application layer, but we're fairly certain that whoever it is, it's going to be built on top of these applications. It's kind of using the social media metaphor. It's not perfect, but it's helpful. You don't know who the best creator is going to be. but you're pretty certain it's probably going to be on Twitter or Instagram or TikTok that they're likely going to get their, big following, for instance.
This is really interesting, Dimitri. So I'm curious, like how this looks in 5 years. Like all of this money has gone into these horizontal platforms, but that doesn't really mean they're going to be the best returning investments. It was kind of the same story during the dot-com bubble. You had all this money going into building the infrastructure, but all of the money was really made by the vertical applications, the software providers, the Microsofts, the Salesforce. Is that going to be the same story here? Are we going to see some companies that have 80% gross margin businesses with a massive moat, or where's your head at with that? What does this look like in 5 years?
Yeah, I mean, I've heard of the dot-com bubble comparison, and I can see why people would feel that. There's a couple of differences there. One is that the capital that is going into these firms, they're coming from businesses that have non-AI related revenue, Amazon, Microsoft, Apple. So even if that capital, let's say, dries up, they still have revenue coming in from their business operations. Mind you, Apple is such a stable company that they have a better credit rating than most sovereigns in the world, right? At least well over 50%, I would guess. So versus in the dot-com bubble, as I understand it, a lot of the capital was coming from VCs who didn't have a primary source of revenue, and their returns only came years and years later from their other investments. So that capital distribution, or rather that origin point, is slightly different. In terms of just overall spending, and this is kind of where it gets into the sovereign part, NVIDIA is already having trouble meeting domestic demand. Now they're expanding internationally, and they don't really care that much about geopolitical alliances. They only are operating on them because the US government is forcing them to, right? Jensen Huang was lobbying the Trump administration to allow them to sell to China, and then they can, but with a caveat, but I'm pretty sure China still can't access, for instance, the A100s. But the majority of capital is still coming into the US because that's where the best hardware is and the best software is. A great way to measure that: who's setting the export controls? It's the US. You can always look at what people are leveraging as the point that they have some dominance in. China is leveraging rare earths. They have a near monopoly. It makes sense. The US is leveraging export controls on these semiconductors. And even if China can't access them, Chris Miller put it best: just because you have a cake, it doesn't mean you know how to bake it. It doesn't mean they don't have the same advanced ultraviolet lithography machines, extreme ultraviolet lithography machines that ASML does in the Netherlands, which for the US, it doesn't make sense to domesticate because US techno-foreign policy and the foreign policy of the Netherlands is never going to diverge. So there's no point for them to re-domesticate it. But yeah, can we actually go to the next chart? Because this kind of solidifies the next point I was going to make about the data. So here, you have AI and ML VC deal value by region. The orange is North America. It's very easy to see who is the clear behemoth here. Now, you could argue, well, Europe has the Chips and Science Act as well. They have Mistral, which is a French foundational LLM. But even under those circumstances, if you actually look at the funding for Mistral, the European VC ecosystem is optimized for, right now, just doing early stage. Even getting government, let's say, backed capital is relatively easy, relative being the keyword here. But their later rounds had to come from the United States. So even France's national champion, and Europe's, by extension, national champion, who came to LLMs, relied on capital from across the Atlantic. So even under those circumstances, you still see a lot of capital concentration in the United States, and even coming from it to other countries, because no other region or country has the same robust ecosystem, essentially, that the US has, and that's a point of leverage. So in short, what I think you're going to see is more capital concentration in the US. Sovereign AI, I think, is going to turbocharge it because no country wants to be left behind technologically. And it's going to come in two waves. You're going to have training first, and then you're going to have inference. The inference market is about 2 to 4 years out, depending on which region or country. In the United States, it's probably shorter, or in Europe and Singapore, because you have a much more digitally indigenous population versus, let's say, the Middle East. But for them, the flip side of that is they don't have a lot of energy constraints. Like Norway and the UAE were the two first countries to receive the data center build-outs from the Stargate venture in the US. I don't think it's a coincidence that both of those countries are petroleum-based countries. So of course the energy problem isn't that acute for them. And then there's a number of companies, last thing I'll say, that will essentially benefit from this, because I think between now and 2030, you're going to have capex on data centers reach about $6.7 trillion, with chips making up the majority of that. And in the report, I won't go through every single point of it. In the report, you will also see that I make a list and a table essentially of publicly traded and privately traded companies that are at the center of it, whether it's data center infrastructure, semiconductors, cloud infrastructure, interconnects, foundational models, optical interconnects, cybersecurity, et cetera, that are all benefited slash poised to benefit from the sovereign AI build out that is concentrated in the US. D-Matrix AI, CoreWeave, Crusoe Energy, Cerebras Systems, three of which, by the way, I actually interviewed for the paper, and they provide their unique industry insights on it as well.
So we got some questions already. So Wavy's asking, can he address the vendor financing and the apprehensions people may have that tech companies are copying many activities that took place in the 90s?
Yeah, that's a great question. The truth is, I'm still trying to figure that out myself. I've seen the charts. We've all seen the memes of people people passing capital between each other. That is a similar parallel where people, I think, saw a lot of concern. My sort of take on this is that AI has not penetrated a lot of organizations, and even the ones that they have, I still think you're not seeing a lot of the value there being driven. There was that MIT report that came out a while back saying 95% of companies didn't find benefits from implementing LLMs. There's a little nuance there. The report's methodology was a bit flawed. And in my view, it's not that companies don't want to implement AI. They're just trying to figure out how to. That's why you have companies like DeepSense AI, which are consulting firms that come in there essentially to bridge the gap between, let's say, OpenAI's LLM and an enterprise wanting to adopt their model into their workflows to optimize it. Regarding, though, to answer your question more directly, the vendor financing, I wonder if maybe that'll change when OpenAI plans to IPO, which I think they're aiming at $1 trillion IPO in either late 2026 or 2027. A lot of people say, well, they're operating at a loss. I think what they're doing is the Uber strategy. They're first focusing on cheap but massive implementation. Once they become embedded, it's really hard to digitally uproot. No country will want to. And then gradually they will raise their prices. And then that's good. They'll have to be more profitable. Remember, like Tesla wasn't profitable for a lot of years, and yet it became one of the most valuable companies in the world too.
Interesting. So I guess the big question now is, all this is going to turn a lot higher energy usage. So have you looked at any of the projections for where, how much copper we'd possibly need, how much silver we'd possibly need? Energy wise, like it looks like Sam and I, we keep going through all these sectors, right? And we're seeing things like, hey, lithium is continuing to make a new uptrend. Coal stocks are starting to move. We're looking at uranium is just mooning every other day. Then we're also obviously our gold, and then silver miners, and then copper miners, and so on. So we're kind of seeing this massive move in the whole energy space, whether it's metals and mining or into most of these new metals that are going into these different technologies at the moment. So what are you thinking wise about the commodity cycle? Do you think this is going to go into the commodity cycle at all? Or do you think this is something that is going to go the other way? Because a lot of people have the idea where technology is actually deflationary over the long term, which has been proven to be pretty true. So what do you think about that? Do you think it's going to be more deflationary, or do you think short-term inflationary and then deflationary? What's your thoughts?
Yeah, I mean, technology. So I've heard the argument that technology is deflationary in the long run, and that is true. I think it depends deflationary in what sector or industry, for instance, because there's two factors to consider. One, you still need power to program these technologies that lead to these deflationary trends. And the second variable is the innovation in chip use and what kinds of chips, right? Because you can use a GPU to train and to run inference. But the thing is that the compute to power usage ratio of a GPU versus an inference optimized chip is significantly different. You'll still need to train and update models, but you'll also then need to create a new series of chips that can work within, let's say, a more constrained energy grid. Now, you might think, well, okay, the counter to that, I think it's called Jevons paradox, I think is the one where
Yes.
it's like, okay, well, you get more efficient chips, but then that means more people use it, so it kind of offsets the initial ones. I don't have a clear cut answer for that right now because there are so many variables that it's incredibly nebulous. What I can say with relative confidence is that I do think you're going to continue to see commodities that are high value in energy, like uranium is a big one. Oklo is up like over 1,000% year to date. I think you're going to see a lot of those companies continue to capitalize on the forward-looking narrative that energy will be big. Now, which of those companies will be winners? Unclear. I think right now we're caught up in a lot of, how do I put this? Narrative-driven price action, to put it diplomatically. I think what we need first, what will give it another boost, or that could throw cold water on the party, is regulation, or lack thereof, to be specific, or deregulation. That's kind of my take on it. I think commodities will, so certain select ones, benefit from it in two ways. Like I said, the narrative driven price action initially, and then how that is actually then deployed. The deployment, and in between that too, the bridge is the policy. And the policy is either what will extend, let's say, a rally in some of these key commodities, or it'll cut it off by its knees.
No, I agree. I think that's well said because I think it's to me it's very inflationary short term if I look at it. Just the idea of how much we're going to actually have to use, not to mention the type of environment we're in globally at the moment, would probably give a nice spike to commodities in the short term. Long term, I'm not too sure, looking 10 years out. But that's what we do as traders. As a trader, like I'm not really that concerned with what's going to happen in 10, 20 years. I'm more concerned in what's going to happen in the next year. So this is a really good guide to kind of see what all we're looking at here, because a lot of people haven't dug into it like you do. So, before we go, and if anybody else has any questions, please drop them in the chat. But before we go, is there anything else that you're thinking of that people should be on the lookout for here, as pertains to AI? What do you think?
Absolutely. So I'm going to be authoring another analyst note soon, and I'm doing some research on it now. I've interviewed about 20 startups in the space already, and cybersecurity. That's going to be the next big one. There is more at stake, and I know I'm biased here because I like to cover geopolitics, but I've spoken with a lot of these startups, and foreign-based cyber warfare is a huge driver of risk. LLM poisoning, Anthropic put out a big note about that, where you actually only need to put in a couple of documents in order to completely poison the well, and it can be triggered by very unique phrases that are only known to the hacker. You also essentially have basically every AI attack. Just imagine it enhanced. So let's say there's a traditional attack that would take, I don't know, 3 months, and you need to have highly specialized people. There was a report, there was like this YouTube interview done with Vectra AI. I highly recommend people check it out, where they give a matrix of the kind of AI attack, a traditional one versus what it would look like with AI. It went, and they do a brilliant comparison, but the two takeaways are: one, the time went from 3 months to 2 hours, and it went from high skilled workers to no skilled workers. And in the same way that we see vibe coding, you're now going to see vibe hacking. And I think cybersecurity is going to capitalize on the increased risks of AI, specifically when you're transferring data, when you're running inference, when you're training it, and from just essentially securing these data centers, and from all the different potential polymorphic agentic AI attacks you're going to have. Polymorphic attacks aren't new. They've been around since, I think, the 90s. But how they're able to respond is different, and how LLMs hallucinate and what algorithms are doing. So I think cyber is really going to benefit from increased cloud spending. I think it's going to outpace. I think AI enhanced cybersecurity is going to outpace IT spending at a CAGR of 9 to 12% over the next 5 years. So there's a lot of space in cybersecurity where I think you will see tremendous growth.
So you're saying when we get online some days and nothing is working, which just happened like last week, there's probably an issue there. You know, like for me, I continue to pay a lot of attention to this because there's so much here, geopolitically, for the markets, for the sector of cybersecurity as well. And so I'm glad you highlighted that. So when does this report come out?
The cyber one,
Yep.
that will be early December,
All right.
early
Well,
mid-December.
we're gonna have you back for that one. That's gonna be exciting.
Totally. We have another great question in the chat just asking about the cybersecurity industry. Do you think there needs to be some consolidation there? Um, I guess there are some rumors going around that that needs to happen. What do you think?
I think it's not a matter of it needs to happen. I think it already is happening. Essentially, a lot of companies, like if you're a customer, you don't want to stitch together a bunch of different solutions from different companies. You want to approach just one company that has a whole suite of services that you can just essentially capitalize on. Not capitalize on, but essentially you can access. So rather than saying, okay, Jason, I'm going to go to you for this. Sam, I'm going to go to you for this. Spencer, I'm going to go to you for this. It's okay, I'm just going to go to one person. I'm just going to go to one cybersecurity solution provider, and they're going to provide me a suite of solutions. So cybersecurity is still one of the most fragmented, if not the most fragmented sector within IT. What you're seeing now, and the data shows this, you're seeing increased M&A. Part of that is specific to cyber and AI, like through acqui-hires and just general platform consolidation. You see higher retention rates, you see greater profit margins, but you also, and there's the network effect, which was also beneficial. But you also see increased consolidation through M&As as a function of the macro conditions, right? So if you have high interest rates, you see more M&A activity. If you have lower interest rates, generally you see higher IPO activity, which makes a lot of sense as far as sentiment goes, and how it feeds into the models. So I would say you're going to just see increased consolidation on cybersecurity platforms because that's generally what gives them a much better moat and differentiators by having these different AI basically AI tagged solutions. And those companies that are AI native, that are cybersecurity companies where the AI is indigenous to their product / service, they're likely going to have better exit prospects and better post valuations than their non-AI counterparts.
Love it. Good stuff, Dimitri. So as always, man, it's a blast to have you on. Excited to see you soon again. Whenever that
Totally.
comes
You're
out.
just such a wealth of knowledge, Dimitri.
Yeah,
Thank you for coming
he
on.
knows so much, so much.
Gosh.
I mean, like, so, like, once again, like, I'm even gonna go back and watch this again because there was so much good information here. So I'd suggest everybody else do the same thing. I'll obviously send a replay note out, probably this weekend for anybody if they want to check it out. But Dimitri, as always, man, thanks for coming on. It was awesome to have you. Sam, thanks for hanging out with us. A lot of fun, great questions you brought up too.
Totally.
Let's
This was awesome. Seriously, you should come on again in December after you publish that cybersecurity note, Dimitri. We'd love
Be
to have
happy
you
to.
back.
It's unanimous now. It's unanimous.
I have
go.
I have a couple of other reports coming up before then, so I'd love to hop on the show and talk about them more. And yeah, Jason and Sam, great to be here. Really enjoyed your questions, and yeah, looking forward to coming back on again and talking more about this. And yeah, if anybody has any questions, I think my Twitter, I might have put it in the bio, but if not, shoot me an email, send me a DM on Twitter. I go on X Spaces and do these kinds of shows fairly frequently, so would love to feature some of your questions too.
I'm gonna drop your Twitter link in the chat. So all right, guys, thank you guys so much for hanging out. We'll see you guys soon.
Awesome. Thank you.